and the relationship building, which is a very important part of this. But now we're going to get back into the program. We're going to have a conversation on a very important component around the capital from venture capital investment perspective. So I'm going to welcome some friends to the stage. Keli Callaghan, who's a partner with Arrington Capital. They're a great partner and friend of this operation this week. We have Brian Lee, who's a senior investment analyst with A100X, also a great partner to us, who's going to moderate this discussion. We have Ken Mooney, who's a member of Chain Reaction Boston, also an advisor to our Cubic Labs Accelerator program. And we have Jeremy Wallace, general partner and head of venture with Chainview Capital, also an advisor to our Cubic Labs Accelerator program. Please join me in welcoming them to the stage.
Well, first of all, thank you to Cubic Labs and everyone here at Boston Blockchain Week for being here. I'm very excited to be on this panel. We have three incredible investors, and without further ado, I'll let them kick it off with their intros and tell them a little bit about, how a little bit about their background, a little bit about their funds. So, Ken, would you like to start?
Thanks, Brian. So I'm a longtime angel investor, but really the last 5 years I focused on blockchain, Web3, and crypto-type related investments. And we're doing the investing through a local angel group called Chain Reaction Boston. And as my side gig, I'm a professor at Suffolk University. I teach Intro to Financial Technology and Blockchain Revolution.
Awesome. Chain Reaction is a great group. Everyone should join. I'm Jeremy. I'm with Chainview Capital. I've been at a few different firms in crypto for about 8 years now, focused on early stage crypto investments, primarily trading technology and picks and shovels, financial services companies.
Keli Callaghan, I'm a partner at Arrington Capital. Prior to Arrington, I was a CMO at Algorand, a project here out of MIT with Silvio Macaulay here in Boston. Was their CMO for 4.5 or so years, and then I joined Mike at the fund. We're a hedge fund. We have both liquid trading as well as venture, private venture investments, probably well over 300 at this point. I love working with early stage founders and sort of giving back and making sure they can bring their stuff to life.
Awesome. Well, I want to kick things off with the theme of this conference. AI has definitely had its breakout moment, and we've seen over the past few years blockchain AI weave into the investment narrative, whether it's through decentralized compute, data labeling, and cryptographic identity. How are you guys seeing blockchain integrate into the AI tech stack, and how does it shape the bets you're making? Keli, would you like to start us off?
Oh, right into it, huh? Listen, I think there's a healthy balance between the two. Someone asked, I forget what podcast I was listening to earlier this week, and it was like, is AI going to impact crypto, or is crypto going to impact AI more? And there's a nuance to that, right? Because I think it goes hand in hand. I'm not sure that I would pick one versus the other. I think that AI being decentralized is hugely important, and I think that crypto gets to disrupt AI and sort of keep it in check. And we're seeing that. We've invested in a couple companies doing decentralized inference and sort of looking at those models. And then on the flip side, AI makes crypto much better, right? So you've got companies like, we've got one, Giza, who's creating AI agents that are going out and doing your yield for this. We talked about this on a panel yesterday where it'll be very easy for anyone, regardless of their background and financial understanding and knowledge, to come in and just say, okay, this is my risk profile, this is my tolerance for this is my length of time and outlook that I want to have, go do. And that's it, right? And those AI agents will just go and make crypto and the yields and participating in all that a lot easier. So I think it's hand in hand. I think it's exciting times that we're in here for that.
I think there's a lot of unknowns. AI has certainly enhanced everything, right? Hacking has always been an issue in crypto. Now Lazarus and other groups are using AI to, integrate into their hacking. there's certainly some new business models, but me personally, I've only made a few investments with the two, one in the data space and the other around security. It's a company called Test Machine. They have a partnership with Coinbase, and essentially what they do is put your smart contracts into an AI model that continuously attacks them, which theoretically enhances security. So I think AI is certainly converging with crypto and blockchain, but more broadly speaking, it's a tool to enhance existing business models.
Yeah, I guess I'd echo that too. I'd put blockchain in the front seat, unbiased, of course, and AI as kind of a complement. It's really a good tool. I don't know if people saw there was a recent MIT report on the ROI on AI, and it was really poor. And I think part of it is that AI may be applied in the wrong places. I think AI is really good for things like automation, predicting trends, enhancing security. So when someone brings a proposal to us and it has AI associated with it, I'm just looking at that as really as a tool that could potentially make it better. And quite frankly, I don't think there are any angel groups I know of that invest strictly in AI because the valuations are crazy, and I don't see how you can even invest in one at this point.
Could not have said it better. Well, I would like to pivot to the hottest narrative of the past 18 months, which is stablecoins, which are cryptocurrencies pegged to fiat currencies. And we've seen over the past 18 months, both enterprises and financial institutions build their own stablecoins as well as layer ones that are designed for stablecoin payments. How do you see the stablecoin landscape shaping up in the future, and how has it impacted the investments you've been making? Ken, would you like to start?
Yeah, so I think we're seeing more opportunities that include stable coins. Certainly the Genius Act makes it a more legitimate type of thing. What I'm wondering is that stable coins, there could be it's probably good to have a lot of competitors and not just have a few large stablecoin providers. But I'm looking at it and I'm saying, stable coins, it may make it easier for the large institutions. If the large institutions get involved in stable coins, and it can help with custodying assets and doing things. And of course, we know that stable coins are great for global transfer types of things. But I think, the big money is always in the capital markets with the large institutions.
Yeah, I think from a macro perspective, speed of transactions has continued towards instant settlement, right? Started out T+5, got it down to T+2. Now we're somewhere near same day settlement. Stable coins allow for instant settlement, and I think they're going to eat every part of the economy. So globalization is certainly not slowing down. We're going to be instantly settling every transaction that we're a part of. So whether it's escrow, cross-border payments, I think stablecoins is an integral piece to all of that.
You were talking about institutions. Do you think that any of the big retailers or non-financial institutions come in as big stablecoin players that disrupt anything and shake some shit up?
The large institutions, the big tech, as I call them, Amazon and Google and Apple and those types of companies, they don't like to get their hands dirty, I would call it. They like to have Goldman or one of those small companies do a lot of that low margin stuff. But if they get involved, I see them maybe getting involved with a partner, that knows the business really well. But if the business is growing, if there's more transactions in stablecoins, they'll certainly be involved.
Yeah, I think the number of players increases here. It can't just be USDC and Tether, right? I think there's going to be some. We've invested in a couple that are very specific to one particular industry segment or rail between different geographic areas in the world. We've done some that have unique yield opportunities. So I think there's a lot more opportunity for stablecoins and infrastructure and what they bring.
I think a lot of the middlemen, so to speak, like Stripe, realize how much money Tether and Circle are making and are making a big push there. Google announced that they'll be getting into stablecoins as well. Amazon. I think the economic incentives are there. Now the legislation is in place that it allows them to enter the arena. Certainly there's a bit of catch up to get to where Circle or Tether are at, but once they turn it on, it should be a seamless integration, and you probably won't notice a big change. When you're checking out on Amazon.com, the tech might just run in the background. So that's how I see some of those larger firms going to market.
The last thing, one of the previous presentations talked about stablecoins destabilizing the banking market. Too much of a flow goes towards the banks because if you can earn money someplace else, why wouldn't you do it rather than leave it at JP Morgan? So if something like that starts to happen, deposits flow out of as an ex-banker, you need deposits, right? If that starts to flow, that's when probably the government steps in, probably.
Well, I think we're talking about the institutional level, but think about on the individual level and what stablecoins open up. I mean, it's still clunky if you want to, take more than, what are the limits on Venmo? Like a couple $1,000s out a day, and you can't do wires for more than XYZ, or it takes 3 days. They don't even tell you if it actually ends up coming through. Versus even for individuals, what it opens up, and the government might step in, or stablecoins might just become better.
I think right now, BitGo and Anchorage are really the only two fully regulated custodians. They'll continue to see, quote unquote, deposit flows into those products. There is a possibility that they even start acquiring small and medium-sized banks to, tag on that additional regulatory approval. But yeah, I think the banking system is going to look a lot different in 5 or 6 years from now.
Really good observations. We saw Anchorage about a couple months ago acquire Mountain Protocol, which is a stablecoin player. You guys touched upon some amazing points, one of which was the investments in different stablecoins in different regions and the ability to find product market fit in different areas that we may not anticipate. We have some amazing founders here. Would love to get you guys' advice on how these founders can find product market fit, both in the consumer sense and in the enterprise sense. Keli, would you like to? Jeremy, let's.
Yeah, Mountain was actually a previous investment of mine, and going after a high yield stable, certainly doesn't work in the U.S. yet, but for LATAM, Africa, emerging economies where access to dollars is difficult, a product that not only allows you, access to a stable currency, but additional yield on top of that, simply through a phone, I think is an incredible product, and that's why I think Anchorage made that decision. They're rolling the global dollar network out, not only in the U.S. but abroad, and there's a lot of incentive for individuals to adopt.
Jeremy suggested that we do Mountain, and we did not do Mountain Protocol. Thanks, Jeremy. But we have invested in a couple of stable coins before and since. I think if you step way back, there's a takeaway that's we're still making investments in infrastructure because there's still areas of improvement there, whether it's dev enablement, dev tooling, infrastructure products. We're still doing infrastructure. It might be industry specific. A lot of times it's stuff that we can use as a hedge fund that makes our lives easier. But there's still infrastructure, there's still security that covers a whole bunch of different things in Web3. And that's still happening because there's a lot that still needs to be built and everybody's okay building it. I think the other thing we should talk about on this panel, if we're doing advice to people fundraising, is sort of valuations and how you run and play that game. We've seen this year has probably been a lower activity for us on private early stage ventures because capital is going to go where it's treated best. And if it's treated best, it's going to have better returns. And when you have opportunities like some of the digital asset treasuries that are very quick turns and much faster paths to liquidity versus a private early stage startup that has, really big dreams for what that valuation is, it's very easy for us to make that decision on where to place capital. So I think valuations have been high. I think they're starting to come down, and I think that'll shift. But I would just say, be aware of that, and it's not just what's happening in startups. It's like, look at what other people's opportunities are in the segment that you're playing.
Do you want to continue with valuations and fundraising, or
Sure, that
product
sounds great.
market fit? As an angel investor, we're kind of the bridge, I think, after friends and family and, sweat equity and that sort of thing. And after you've exhausted the money from your family, you need someone sometimes to bridge you to venture capital. And so we always see applications, that are pre-seed. Sometimes seed, but usually pre-seed. So they're very early on. It's very hard to invest in a company when there's no revenues, no subscribers, no customers. So one of the things I look at, you want to have a good team, right? If they've done it before, that's even better. You want to have a market that if they're successful, it's going to pay off. I mean, sometimes you see opportunities, but they're in small markets, and even if you're successful, it's not going to pay off. So, but the thing I always look at that it seems like the failure, most of the companies that fail because of this, they don't have a good go-to-market plan. Go-to-market, because let's face it.
100% agree with that, totally.
But, I mean, why do companies fail? They don't have customers. They don't buy the product. You may have the best product in the world, but maybe there's a few other ones already out there, or people aren't going to switch or whatever. Or it's a customer discovery, get the product market fit, the best one you can, be able to pivot. It's the lean startup stuff. But if you come to us and you have a few customers or you have some revenue, I mean, I always think that's a step up in getting angel investing.
I think founder market fit too, which is just a part of go-to-market. Will they be able to sell this product in the vertical that they're going after, and will those customers respond well to their background? Especially now with regulatory movement, a lot of institutional capital and companies are coming to the table. They're not going to interface, initially at least, with an early stage startup. They're going to go to established players that either have a solid balance sheet, reputation, or a background in that. So at the earliest of stages, having the proper founder that is coming from the vertical that they're building in, I think is so crucial.
I think you could also have founders who are very technical and I've solved this one mathematical problem or this one thing that could change the world here. But if they're not the go-to-market person, if they're not the public evangelist, and they're also not willing to bring in a co-founder or bring in someone who can work with them on that or be that partner for them, there's a red flag there, right? Not everybody's good at everything. I know what I'm terrible at, right? And I'm good with that. But we see founders we've invested in founders who are very open to partnering with someone that's stronger on the go-to-market side, and they recognize that, and they're willing to talk about how that's not their strong suit. And then we've got other founders that will pass on because they're just very adamant on this is it, and it's just going to organically grow, and people are just going to come and find us and use it.
You know what's kind of interesting is that after you raise the initial capital, maybe you get a grant, from some place like Cubic Labs, to put in a plug for our host. And they get the resources, they get off the ground, they get a little angel investing, and you want to get to the venture capital. I think you got to show traction. You got to show some sort of traction to convince people that you've got the right idea. And what we like to do with Chain Reaction is we like to know some of the venture capitalists that are out there, because you got to think about the next funding round too, right? Because no one's going to be able to raise enough money initially to get you through all the way. And if you raise enough money, you've given away your company, probably.
I'm glad that we touched upon both fundraising and go-to-market. I guess something that falls somewhat in the middle of the two is a large part of crypto companies' journeys are the token generation events, or TGEs. When advising your founders, what are some best practices that you give them as they approach the token generation event?
Well, I think there are so many tokens out there, right? If your token has utility, I think it's worth more, probably. I mean, I kind of look at tokens as kind of an add-on. I'm an equity investor, the SAFs, I'm not as interested in that. I'm not saying we wouldn't do one, but I like the idea of if you're going to do a safe, it's got a warrant, a token warrant or something. And I also think, liquidity is an issue. And then you've got regulatory things you have to think about with issuing tokens.
Yeah, I think optimizing for a long-term hold is the most crucial component to the token, because even if you have an incredible team, great products, if there's no incentive for the community to buy in and not sell out in 6-12 months, that liquidity dries up. And I'm sure we're all aware of several dead tokens out there. Hype is a great example. I'd say stick to proven token models. Rev share, obviously in the U.S. it's unclear where that's going to fall from a regulatory perspective, but I see utility tokens, being involved in sharing of profits, et cetera.
Yeah, I mean, we're big fans of tokens because we think there's different liquidity models, there's different economics that can more easily flow back, but it comes down to you got to do it right. You can't just tack it on and be like, I'm going to launch a token. Let's go next week. Yeah, Tuesday. You got to put the thought into it. It takes months. You got to talk to everybody that's come across and been involved in your project, your investors, your customers, people that haven't used you yet. What else is going on in the market? And you have to build out these tokenomic plans that actually make sense, that are transparent, that have value accrual back to the participants in the ecosystem, and it has to be like a well thought out program. It can't just be shoehorned, and it can't just be an add-on, right? And we've seen some companies that have had very thoughtful approaches to TGEs and the tokenomics and the utility of it, and that makes a huge difference. And I think the other thing to add is just the token launches right now and the exchanges. There's a lot of shenanigans, and they can get very expensive, and it's not super clear, and there's a lot of percentages that are given to those. I think that is all really hard, and there's got to be a better way, and I don't know how that plays out over the coming years.
Absolutely. I have one more question, then we'll open it up to the audience for questions. Something that really stuck out to me was Keli's comment about investing at the infrastructure layer. Unfortunately, in venture, when you're too early, that unfortunately also means that you're also wrong in terms of investing in the growth maturity of the crypto space. How do you see the investments in infrastructure versus middleware versus application layer playing out today, as well as 2 to 10 years down the line?
Yeah, timing conversations. We're still doing a lot of infra, less on the apps and consumer apps. We've done very minimal on the DPIN stuff, and you could argue that's a little more consumer appy. And it's really because the value accruals, like where the value is coming back to participants in the network, haven't always made sense in a lot of the stuff that we've seen, and so we haven't done too much of it, for what it's worth.
How I think about crypto is strictly, geared towards a financial tool. Blockchains are a ledger that solve the double spend problem. So really, I think all infrastructure has to have a component of that. Certainly, that is going after financial markets. Maybe decentralized compute and some of these, newer ideas will come to fruition in a couple years. But for me personally, I try to keep to the financial perspective.
Do you take that approach on a global basis or U.S. only? Does it matter, do you think?
Global.
I guess infrastructure, and by the way, in preparation for this panel, I just went back and looked at the last 50 or 60 applications that we got. And by far, infrastructure was the ones I saw the most. Tokenization and then DeFi. Those are the three that we've seen in the last 4 or 5 months, probably. Infrastructure, I guess what I think of is, in a way, it's kind of bare bones right now, right? I look at where are the biggest problems, who can solve those problems, where's the flow? Because if you have a gigantic flow, that's where you can make revenues, right? You can make money off that flow. So, I think interoperability, right? Being able to go across platforms, that's a huge issue. I'm just onboarding in fiat, going from fiat to crypto. I feel like sometimes we're, and then I'm a Neanderthal when it comes to that. We're at that stage. So that's how I look at infrastructure. What's solving the biggest problems?
Fantastic. I want to give the opportunity for a question in the audience.
Hello, thank you so much for speaking today. So my startup is early stage. We have launched for 7 weeks, so not very much track record yet. But we already have a few customers, we have some revenue, and we were told by an advisor that we trust that we should actually wait until we have 5 million in TVL before we want to do a big retail push. What do you think about that?
You mean organically grow to that 5 million
Yes,
and then
that's
spend
right.
money into increasing it your next 5 or 6x?
Yes.
I think that's logical. I think that your earliest users, adopters, are going to be the ones that are the most brutally honest with you. So I think what's really important in that first 5 million of TVL is to figure out how they're using it, why they're using it, what they're doing, what their behaviors are, what feedback they have, because then you spend the money and the time there, spend your resources there, and then that'll make the next bump up a lot easier, would be my 2 cents.
Yeah, I would tend to agree with that. Only case being, if there's a strategic VC that can help with distribution in a big way, tap into their user base, certainly pursue those opportunities, but organic growth to 5 million sounds like a great plan to me.
So I'm not thinking of the plan, I'm thinking of the cash. So part of it is, do you have enough money, right, to get to that point and show that kind of glide path. So part of it is sometimes you have to raise money and you can't get the valuation you want. But if you have the internal resources, you want to show as much growth as possible, you get a better valuation, and you can, maybe you can raise more money.
I think we have time for one more.
Hey guys, so there's about 250 stablecoins out there, call it 300 billion of value. Keli had mentioned that there are still some interesting projects that have very specific niche audiences, right? So if you're creating a stablecoin, what is it that's appealing as an investor? What's appealing about a stablecoin founder who says, hey, I got a niche interest or a niche target market, versus someone saying, I'm going to be the 251st generic stablecoin backed by treasuries?
I think it's just like, what's the value there? Is anybody else serving that market? Is anybody else serving that, corridor of payment infrastructure that's needed? And so I think, and what's the yield? And if they can't make it work because nobody's catering to them or servicing to them, but it's a large enough market, if the TAM is good enough, then yeah.
Yeah, I think if it's a new geography, for example, Japanese yen stablecoin or something like that, or is it some sort of new product where it's a Bitcoin stablecoin? I think there's a ton of potential in that. Being like you said, the 250th treasury-backed stable isn't exciting. If it's fractional reserve banking, that could be interesting, but that's not really allowed in the U.S. yet or the EU. And it's really all about distribution. Like, even if they have a niche product, can they capture it, and how do they get there?
Yeah, how long can you hold on to the market, too? If it's in a niche market, and you're first there, and maybe you establish yourself, but maybe it's a lucrative market, someone else jumps in, too. So sustainability.
I think we're out of time. Let's give a round of applause to our panelists.